Gold just hit $4,715. Silver exploded past $80. And the people who called this a bubble 3 months ago are very quiet right now. But here's what actually matters. This rally isn't over. In fact, if one specific signal plays out over the next 60 days, we may look back at $4,700 gold, the same way people look back at $1,200 gold in 2018. I'm going to show you exactly what that signal is and why the smartest money in the world is still buying right now at all-time highs. Section 1 set the scene. Let's talk about what actually happened this week. Gold closed near $4,715. Solid week. Roughly 0.6% gain. But that's not the interesting number. Silver surged 2.3% in a single week, blasting past the $80 level that analysts said wouldn't break until late 2026. It broke early, and that timing matters more than the price itself. Here's why. In every major precious metal cycle in modern history, 1979, 2008, 2011, gold moves first. Institutions buy gold because they want safety. Then, once the trend is confirmed, silver explodes. Because silver attracts a completely different type of buyer. Not fear money. Momentum, money. And when both are rising together, gold steady, silver accelerating historically, that combination has signaled one thing. The cycle is not ending. It's entering its most aggressive phase. Pattern interrupt, keep viewer from leaving. Now, before I show you the signal, smart money is watching. Let me tell you what most people are doing wrong right now. Most retail investors are sitting on the sidelines waiting for gold to come back down. They're saying $4,700 is too expensive. They said the same thing at $2,000. They said the same thing at $3,000. Here's the question they're not asking. Expensive compared to what? Section 2, the real story, central banks. Because while retail investors debate whether gold is too high, central banks are buying at a pace never recorded in modern market history. Q1 2026 global central bank gold purchases came in at their highest quarterly level on record. China, India, Poland, Turkey, multiple BRICS-aligned economies, all adding physical gold, all reducing dollar-based asset exposure. Now think about that carefully. Central banks don't buy gold because of YouTube videos. They don't buy because of fear or hype. They buy because they are repositioning for a world they believe is coming. A world where the dollar is still powerful but less dominant. A world where hard assets matter more than paper promises. And here's the uncomfortable truth. When the largest financial institutions on the planet all start moving in the same direction quietly, retail investors usually find out last. Section 3, the dollar problem. Now, let's talk about the other side of this trade. The US dollar index, the DXY, has broken below 97.8. That is not a small number. That is a significant structural level that dollar bulls have been defending for months. And it broke. Why does that matter for gold? Because gold is priced in dollars globally. When the dollar weakens, gold automatically becomes cheaper for every buyer outside America. European buyers, Asian buyers, Middle Eastern sovereign funds, all of them can suddenly afford more gold for the same local currency. That demand doesn't show up in American headlines, but it shows up in the price. And right now, dollar weakness plus central bank buying plus silver breakout are all happening simultaneously. That combination doesn't happen every year. It doesn't happen every decade. Section 4, the signal. Gold to silver ratio. Now, here's the signal I mentioned at the beginning. The gold to silver ratio, right now that ratio is compressing, meaning silver is outperforming gold and the gap between them is closing. Historically, and I want you to remember this number, when the gold to silver ratio drops below 60 during an active bull market, silver has produced some of the most violent price moves in commodity market history. 2011 silver went from $18 to $49 in roughly 8 months. 1,979 silver increased over 700% in under a year. Now, I'm not predicting those numbers, but I am saying the same ratio compression that preceded both of those moves is beginning again right now. And if silver pushes toward $85 with strong volume behind it, the momentum traders, the hedge funds, the retail FOMO wave, they all come in at once. Small market, massive capital inflow. You do the math. Section 5, silver's secret weapon. Here's something the gold-only crowd consistently misses about silver. Silver is not just a monetary metal. It is the most electrically conductive metal on Earth. Solar panels, AI data centers, EV infrastructure, military electronics. Every single one of these industries requires silver, and demand is accelerating, while new mine supplies failed to keep pace for 3 consecutive years. So silver has 2 engines running at the same time. Monetary demand as a safe haven when trust in currency weakens. Industrial demand as a critical input for the fastest growing sectors of the global economy. When both engines fire together, supply cannot keep up, and prices move in ways that catch most investors completely off guard. Midpoint tension rehook viewer. So let me ask you something directly. If you knew, not guessed, but knew that the largest buyers in the world were still accumulating at these prices, would you be waiting for a pullback? Or would you be asking a different question entirely? Section 6, the macro trap. Here's the environment gold and silver are operating in right now. The Federal Reserve is trapped. Inflation is still running near 3.5%, not the 2% target. Not even close. Oil above $95 means energy costs stay elevated, which feeds directly into everything else. But the economy is also softening. Growth expectations are being revised downward. So the Fed cannot raise aggressively. That risks a hard landing. And it cannot cut. That risks inflation accelerating again. That is called a policy trap. And historically, when central banks get trapped between inflation and growth, gold wins. Not because gold is exciting, because gold is the only major asset that doesn't require a government to keep its promise. Section 7, psychology of the market. Now, let's talk about the most important thing in any market. Not charts, not fundamentals. Psychology. Right now, retail investor sentiment toward gold is still skeptical. Google searches for buy gold are not at euphoric highs. Coin dealers are not reporting the kind of panic buying you see at cycle tops. Social media is not flooded with gold millionaire stories. That is actually bullish. Because market tops are not built on skepticism. Market tops are built on euphoria. When your neighbor starts asking you about buying gold, that's when you get cautious. Right now, your neighbor is still asking about crypto. Section 8, what happens next? Let's talk about the technical picture. Gold, holding above $4,700, has transformed that level from resistance into support. If gold breaks and holds above $4,750 with strong volume, the next zone analysts are watching is $4,850 to $5,000. $5,000 gold. That number sounds insane to anyone who remembered $1,800 gold 2 years ago. But look at the trajectory. $1,800 to $2,400 1 year. $2,400 to $3,500 8 months. $3,500 to $4,715. 5 months. Each leg is happening faster. That is not random. That is a market that is beginning to price in something structural, not just tactical. Final section, zoom out. Let me zoom out one final time. What is actually happening in the global monetary system right now? For 50 years, the world ran on a simple agreement. Nations exported goods. America exported dollars. Everyone held dollars in reserve because dollars meant stability. That agreement is fraying. Not breaking overnight. Not collapsing next week. But fraying. BRICS nations are building alternative settlement systems. Commodity exporters are increasingly pricing oil and minerals outside dollar infrastructure. And central banks globally are quietly answering a question they never used to ask publicly. What do we hold if we want to hold less dollars? The answer they keep coming back to is 5,000 years old. And is currently trading at $4,000 $715 an ounce. Outro CTA? So is this just another rally? Or is the world quietly shifting toward the next major hard asset cycle while most investors are still looking at their stock portfolios? I think you already know what I believe. Drop your answer in the comments, bull or bear on gold for the rest of 2026. I read every single one. And if you want analysis that tracks the institutional signal, not the retail noise, subscribe. Because the next video I'm releasing covers something even more important than today's price. It covers what happens to silver specifically if the dollar breaks one more critical level in the next 30 days. That video drops soon.